On today's episode of Personal Finance FYI, we are going to demystify that little pie chart that we commonly refer to as an asset allocation model and help you to become a better investor. So are you ready to get started? Personal Finance FYI starts now. And welcome back to Personal Finance FYI, the web program designed to help you make smart financial decisions and to grow your wealth. As an investor, all you hear is that you need to diversify. But what does that really mean? Today we're going to break down the subject a little bit more and give you an understanding of how following an asset allocation model can give you a better risk-adjusted return. Let's begin with the beloved pie chart. Whether investing in your 401k, researching on the web, or working with a financial planner, you get presented with an image much like this. And then you hear a bunch of babble about large cap, small cap, international, etc. As your eyes glaze over, you think, why should I care about this? Why not close my eyes, pick a mutual fund, and forget about it? Well, it all comes down to risk-adjusted return. You see, as an investor, the most efficient portfolio you can have is one that gives you the highest rate of return for the amount of risk that you're willing to take. It all started with an economist named Harry Markowitz. He researched all the historical returns of the various asset classes and found for each level of return you were trying to achieve, there was an optimal mix of investments that would give you the best chance of getting that return at the least amount of risk. And this became the basic premise of having an asset allocation model that diversifies your investment dollars. So to go back to the original question and ask, why not just close your eyes and invest all your money in one particular fund? The answer is you very well could, and you might get very lucky. But what you are doing is taking a whole lot of risk, so way out here on the risk scale, and your return may not be any better than a properly diversified portfolio with a lot less risk. To expand on this, instead of just one fund, say you invest in 3 or 4 funds within your 401k, but they all fall into the same category. Well, you didn't really do any better than just sticking with that one fund, as you are still concentrated in one area of the market. So what about this risk thing? When we talk about risk, we are referring to the potential losses in your account. If you're an extremely risk-averse investor, you invest in something very secure like short-term government treasuries, but you get the corresponding rate of return of that asset, which right now is basically like a money market. To get higher returns, you have to add risk. When you add stocks or higher income bond funds, you're adding more risk with the understanding that it will give you an opportunity for better returns. This is what we refer to as a risk-return trade-off. So now you say, okay, James, I get it. All my money should not be invested in one asset class, but what do all these pieces of this pie chart mean anyway? When we come back, we will break it down into very simple terms. So now you have an understanding of a risk-adjusted return concept. So what are all those categories on the pie chart and why does it make a difference? Remember, you can put all your eggs in one basket and take a lot of risk, or you can spread out your investments into different categories to try to lower your risk and still try to get the same return. In a basic asset allocation model, you blend domestic stocks, international stocks, domestic bonds, international bonds. You might even toss in real estate and commodities for additional diversification. If you want to expand on this, you can break down the domestic stocks into big company, medium-sized company, and small company stocks, or what we commonly refer to as large cap, mid cap, and small cap. Why do you do this? As an investor, you want exposures to all areas of the domestic stock market. Historically, small caps have a higher rate of return than large cap stocks, but they come with higher risk. So what we want is money working for us in each of these key areas so that no matter what the stock market is doing, we have a piece in all the different buckets. The same goes for bonds. Many times you look at a bond fund and you think, that is boring. Why put my money into something that may only produce a 4% dividend yield annually? Well, that is because that's what it's supposed to do. By adding this fund to your investment mix, it lowers your overall market risk while still contributing to the overall portfolio return. So when you put all this together, you come up with an optimal mix of stocks and bonds for your portfolio that meets your individual risk tolerance level. If you are a moderately conservative investor, you might have a portfolio that is something like 40% stock and 60% bond. A moderate investor might be more like 60% stock and 40% bond, and then a moderately aggressive investor that can handle larger swings in their investment account might be more in the range of 80% stock and 20% bond. So in summary, asset allocation is all about building a strategy that blends your risk tolerance with your desired rate of return. So the next time you see one of these pie charts and you hear asset allocation, you know exactly what it's all about. Until next time, I'm James Daniel, and I will see you on the next Personal Finance FYI.